Hello and welcome to our presentation. Sorry, we're running a tiny bit late today. It's just because we had some technical difficulties right at the last minute. Hopefully you can all hear me. If you can, please in chat, just let me know. Just put in a message there that you can hear what I'm saying. Cool, everyone seems to be able to hear me. I'm just gonna, hopefully everyone is already here since we started a bit late, but we'll still just give it a minute or so for everyone to come in. So today, continuing with trend analysis. This is trend analysis part 2 with me, Peter Martin, as part of our advanced aspects of trading course. Now, last week, we, for those of you who were able to join us last week, we began our trend analysis by looking at what is the trend, why it was important. If you recall, we looked at things like the uptrend, the downtrend, sideways trend. We looked at drawing trend lines, and we talked about breakouts. Now, this week, really, we're just continuing on from where we left off last time, and we're going to look at a few indicators that we can use that are related to trend analysis, and we'll look at what those are and how we can use them. Before we get onto that, I will just draw your attention to the disclaimer. Please just take a moment to read that because it is important. As always, I just want to stress everything in this talk is solely for the purposes of education. As I said before, we're going to be looking at a number of indicators and we'll be talking about potential ways to use those. Those aren't actual recommendations from me. They shouldn't be taken as recommendations, or when we look at actual securities, nothing as a recommendation to buy or sell. This is all for the purposes of education. Okay, so our agenda for today, we're going to begin by looking at moving averages, talking about what those are, how we can use them to tell us about what the market's doing, and how we can use that in association with trend analysis. They're really important and really useful. And then building on top of that, we're going to move on to look at envelopes, bands, and channels. These are really things that apply something to our charts that helps describe where price is spending a lot of its time. And then when we see price move out of that, we know that perhaps something unusual is happening. And a lot of the ones we're going to look at use moving averages as sort of a base point on which to build those envelopes, bands, and channels. We introduced the term retracements last week. We're going to talk a bit more about that and why that's important, what it looks like. And then we're going to tie in with that onto this idea of Fibonacci, what Fibonacci is, a special number sequence, and how we can use the numbers in that sequence to give us, in the context of retracements, potential levels of interest. And then, as usual, we're going to finish up with a Q&A session. And so if you have any questions as I'm going along, please just note them down and then put them in at the end in the Q&A part on Zoom, and I will go through and try and answer some of those. Okay, so we're going to begin with this quote from Richard Dennis. Now, Richard Dennis is a legendary commodity trader, a big name in the field of technical trading. He was once known as the Prince of the Pit, and he's reputed to have made hundreds of millions of dollars from trend following trading in commodity markets back in the 1970s and the 80s. Obviously a long time ago, but he is someone who's very successfully used trend following. His quote here says, "Whatever method you use to enter trades, whatever method, the most critical thing is that if there is a major trend, your approach should assure that you get in that trend." So really this is aligned with some of the stuff that we talked about when we talked last week about Dow theory, when we talked about the primary trend, the importance of the primary trend. And really that's what we're talking about here from this quote, is the idea that we want to be trading in the direction of that, make sure we go along for the ride with the big trend. So further to that, we're going to talk about using moving averages. Now, moving average is a method for smoothing out data. Average is continuously calculated to incorporate new data, and for charts, we calculate it across a specified number of periods. Now, you can apply a moving average to any type of data. It doesn't have to be just price data. And in fact, moving averages are used by lots of people, not just technical analysts. Economists use moving averages. Central bankers, policy makers, think tanks use moving averages. They use it on things like economic data, and they use it for the same purposes that we're going to use it, which is to try and smooth out data. One of the things we talked about last week is that fluctuations, oscillations, price noise can make it hard to see what's going on. So smoothing that out can help us try and see the bigger picture. There's two main types. There's actually lots of different types of moving average, but there's two main ones that we're probably going to use the most. That's simple moving average, an SMA, and that gives an equal weighting to all the data points that we are looking at. And so, before that was calculated across a specified number of periods. So that's, it can be anything. It can be a 10-day period or a 100-day period, and you would average across that, giving an equal weighting to each data point in the series of data. Or an exponential moving average, an EMA, and that's an attempt to try and improve on an SMA by giving more weight to newer data. So the SMA, even if it's got a 100-day moving average, 100 days ago counts as much to that number as the most recent one, whereas an exponential moving average tries to be a bit more sophisticated about it and apply more of a weighting to data that's newer, which attempts to improve on it. And you can use whichever one you prefer. For the purposes of this talk, just to keep things simple, I'm going to stick with an SMA or simple moving averages for our examples. So here we have a sample calculation of calculating some simple moving averages. This is sample data from earlier in the year for Rightmove. And it's just got 8 days in there. And we're going to be calculating a 5-day simple moving average. Now, that's a very short moving average. In practice, you probably use something not quite that short, but for the purposes of our example, it's nice to have something so short. It makes it easier to explain exactly what we're looking at. So we've got 8 prices here. It's only the 5th day that we get a simple moving average calculated. That's because we need 5 days worth before we can calculate it. So on the 5th day, we have the current day plus the preceding 4 days gives us 5 data points. We add them up and then we divide by 5 to give us the arithmetic mean of the total value, and that gives us this first day SMA, first day simple moving average of 585.8. Then the next day we ditch the oldest piece of data and we incorporate the newest one. So we then would take the current day and then the preceding 4 again, divide it by 5 and give us a new value. So we can see that the price each day is updating, so it's continuously being calculated, which is why it's called a moving average, because it moves each period change with the new data coming in. And here's a chart showing Rightmove over a larger period of time with a couple of moving averages overlaid on it. So this is a daily chart of Rightmove, and what we've done here is to put on a red line, which is a longer moving average. That's the 100-day moving average. And we've got a shorter one, which is, I believe, a 20-day simple moving average. That's the green line. Now, first of all, you can see that the red line is a lot smoother. It doesn't fluctuate really with price at all. It's showing us it's giving us a much bigger picture of what's going on, and it's smoothing things out to a much greater degree. We can also note that the green line, the shorter moving average, tends to move more in line with price. So when price goes up, we see that moving average go up. When price dips down sharply, we see that simple moving average move down as well. So it kind of traces price. You see it traces price, but after the move. So it's not happening quite at the same time. It's got a bit of lag going on with it. And how much lag you get will depend on how long the moving average is. The longer it is, the more it will lag. We also see a few things, which is that the longer term trend, which is the red line, we can see that is starting to slowly tip up right at the far right of the chart. And we can see that price change is reflected a lot earlier in the green line, which turned up a lot earlier. But we can also see how they cross over with each other, which is possibly an indication of a change of state. So where we see the green shorter moving average cross up over the red longer one, that tends to occur when we saw quite a sharp move up in price. And then when we see that cross under the green, under the red line, we also see that ties in with when we got a really sharp downward push. And then this crossover on the right also comes alongside a time when the market was trending higher. So moving averages have long been used as a trend analysis tool by analysts and traders. And as we saw, they have this smoothing effect, which we've already mentioned, the idea that we want to smooth out shorter term price fluctuations to make it easier to see what's going on. And that can help us to focus or to reveal what is the underlying trend. And because we can choose multiple moving averages to put on our chart, that also allows us to sort of clue ourselves into at a glance what's going on with different trends, with different time frames. As we saw with the very smooth 100-day moving average, the greater the number of periods, the greater the smoothing you're going to see. And what length you choose, that's entirely up to you. You can choose any length you want. As always, with a bit of experimentation, you probably work out what you prefer, and you should always use what works best for you. Excuse me. Some popular values are 200, 100, 60, 20, 10. It's a little bit effectively arbitrary. You can choose whatever you want. But if we are talking about daily charts, then a 20-day moving average is roughly a month's worth of data. The 60-day moving average is roughly 3 months worth of data, which we can see incorporated all at once onto the same chart. So let's do an example. Why don't you in the chat give me a security that you'd like me to apply a moving average to, and we can just have a look at it and see what that looks like. Someone said Tesla, first person to speak has said Tesla. So let me I'm just going to share my screen. So let's have a look at Tesla. So this is in eToro's platform, and I'm going to look at Tesla. So here's Tesla. This is a daily chart. So if we want to add a moving average, I'm just going to click on this icon here and bring up the indicators. Scroll down to moving averages. So I'm just going to select a moving average here. So we can see the blue line on the chart. That is the moving average. It's added as a default 9-day simple moving average. We can see that written up here, SMA 9. Always good to take a look at your settings. So if we click on this cog, we can see what the inputs are, which are our settings. So it's a simple moving average. We could have an exponential one if we wanted, and it's smoothed across 9 periods. But let's make this 20, which we said roughly a month's worth of data. And we can also add on another one. So I'm going to go down to moving average again. Well, now we've got two, and I can make this one, let's say, a red line. And look at my inputs, and let's make this a much longer one. So let's try now let's put in a 60-day one as well. That's not worked the way I wanted it. All right, that's our 60-day moving average. And then we'll add on the 21 as well. It's not working quite as I was expecting to. Okay, well, let's get rid of that. And we'll put this back to the 100-day moving. Okay, so there's our 100-day moving average. You can see that the trend is coming down before, currently in an uptrend, and then bending slightly here. So there's a question mark over whether the trend is starting to shift here. Also, how price is moving in relation to the longer term moving average can sometimes clue you into things. So that when it crosses under and through it, this cross here was a bullish signal. This cross under it here starts to look like a bearish signal, which we can also see reflected in the long-term moving average beginning to change gradient from an upwards gradient to a downwards gradient. So a short-term moving average can inform us about the short-term trend. A medium-term moving average can inform us about the medium-term trend, and a long-term moving average can help inform us about the long-term trend. And as we just said there, a rising moving average indicates an upward trend. A falling moving average indicates a downwards trend. And as these points above say, it's the length of the moving trend is telling you about the length of the moving average is telling you about the length of that trend. So we see an upward short moving average. It doesn't mean that the overall longer trend is upwards, just that the shorter trend is up. Something I mentioned in passing is that the moving average is a lagging indicator. It confirms what's already happened. So it's looking back at older data. And we mentioned this when we talked about macroeconomic indicators. And the same thing applies for technical indicators, that there's three types. Lagging, where it's a confirmation tool. It tells you what has happened already. Coincident, where the indicator tends to change as change is happening. And we also get leading indicators, ones that try to predict changes in the future. Moving averages are always lagging indicators. So they're using past data, we use them to confirm that a change has happened. When we looked at the charts we saw before, when we looked at the image of Rightmove with a long 100-day moving average and a shorter 20-day moving average, every time we saw something changing in the moving averages, it was already after it had already happened in price, but it confirmed that what you're seeing really is happening. So obviously, the longer the moving average, then the more data is included in the calculation. and the slower it will react to changes in the trend. And the less susceptible it is to the influence of short-term blips. In other words, you can be more confident if you're seeing something confirmed with a longer moving average, but you see it later. So there's a kind of trade-off between the reliability of a longer moving average and the faster signal of a shorter moving average, and vice versa. So with a shorter moving average, you're going to see a change quicker, but it might be less reliable. With a longer moving average, you'll see it later, but you can have more confidence in it. Kind of trade-off, and you have to choose what works best for you. And as I just mentioned on that chart we looked at, a simple signal is price crossing a moving average. So if price crosses above a moving average, that can be a bullish signal. If it moves below it, that can be a bearish signal. Moving averages can also act as an indication of support or resistance in a trend. So let me just go back and share with you that chart again. If we look here, so between mid-May, we can see price crosses above that longer moving average. This was a 100-day moving average I put on. And that was a bullish signal. And we can see that what we did actually get is that the trend continued on from that. If you look here in between middle of August, we see price comes down, meets some support and bounces up. And where does that support roughly tend to be? Well, it's where that moving average is. We can see something similar happening up here in late September, almost in the beginning of October. And then here in middle of October, price has dipped sharply below the moving average. Once again, where it crosses, that can be an indication. So that would be a bearish signal. And later on, we see confirmation starting to happen with the longer term moving trend starting to turn downwards. And then this final point, we can use multiple moving averages together to provide more information and to possibly generate breakout signals. So just in the same way as we can use price crossing through crossing through a moving average, we can use that as a possible signal. You can also use two moving averages together as a signal. So where you get the cross of a shorter moving average through the longer moving average, that can give you a signal of a possible breakout. So a method is this dual moving average crossover signal method. As we said, the shorter moving average crossing over the longer can be used as a trading signal. For it to work, it requires a breakout and then a new trend resulting from that breakout for us to profit from. So in other words, if you get the cross, you get the breakout, and a new trend doesn't happen, then you're not going to make money from it because it's a false signal. And where do we get those false signals? We talked about this last week, if you recall. In a sideways moving market, we're going to get lots of false signals, as the shorter moving average will just tend to move back and forth across the longer one, given these whipsaws that give us false signals. So this is a similar kind of, or it's operating in a similar vein to some of the things we talked about last week when we talked about markets in a sideways trend. We get a breakout and we hope, or we think that might be the indication of the formation of a new trend. It's a similar sort of thing here. So let me just look at the charts. Look at meta platforms here. So what I'm I've added another moving average to this one. So we've got this is Meta, which is Facebook, and it's a daily chart. I put on that same 100-day moving average, a simple moving average. That's the blue line. And then we've got this faster one, which sort of tracks with price, which is a 20-day close, a 20-day moving average. And we can see we get this bullish crossover here in early 2023. So the green line crosses above the longer moving average, giving us a bullish signal. And we can see that in this case, we did get the formation of a new trend. So that we got the breakout and then a new uptrend formed and persisted for a long, long time. Now we can see that the shorter term moving average is started to turn down. The longer one is still saying uptrend, uptrend. But we can see they're getting closer. And so you might be at this point thinking, okay, if they cross back over, that would be where we might close the position. And here's another example of a dual moving average crossover. So this is a daily chart of the FX pair euro versus US dollar. And on this, I've got a green line for the faster moving average, which is 20-day moving average, just like we had there. And then the red is the longer one, the 100-day moving average. We can see in June of, this was, I believe this is actually 2022 we're looking at here. Yeah, this must be 2022. So in the June of 2022, we got a false signal. So we got this small cross of the green line above the red one, and then it quickly crossed back down. So that is a kind of a fake out. It's a fake signal. It was saying buy, and then the new breakout didn't happen. The new trend didn't occur. However, in November of 2022, green line crossed above, a bullish signal. And then we can see that did lead to the formation of a new trend that persisted across November into December, into 2023, into January, February, and then you got the crossover all the way on the right of this chart, which is your signal to exit the position. So that's moving averages. Building on moving averages, we've got this idea of envelopes, bands, and channels. Really, these are all sort of the same thing. Envelopes, bands, and channels, they're sort of saying the same thing, which is we get this simple moving average drawing a line that kind of goes through the middle of a trend, and then price oscillates around that moving average. And then what the channels, the envelopes, and the bands are attempting to do is to describe the tendency of this oscillation, like how far does it get away from that middle line. So it's an attempt to determine the range in which we might expect price to fluctuate normally. And then the reason that we do this is an attempt to solve the problem of false signals in sideways trends. So that's always the tricky thing of these false signals you get in sideways trend. When the market's not trending up or down, you might be getting signals saying, hey, here's a new trend, and then it doesn't. It doesn't actually lead to a new trend. So some common types, and there are lots of different types. We're just going to cover 4 main ones today. Percentage envelopes is the first one we're going to look at. And it's probably the simplest of the 4. Bollinger Bands, pretty well-known type of volatility band. Keltner Bands, also another volatility band. And then Donchian Channels, which is, it's actually a bit simpler than Bollinger Bands and Keltner Bands. It goes about its way in a slightly different way, but yields similar-ish results. So let's first of all talk about percentage envelopes. It's also known as a percentage filter. So basically, we're just calculating a set percentage of the moving average. So we plot the moving average on our chart, which is kind of our central line. And then above and below the moving average, we're going to plot an envelope of a certain percentage symmetrically around that moving average line. Now, the idea, as it says here, this is kind of the received wisdom, is to actually use this in a sideways trend. So you're trying to choose a percentage that covers most of the oscillation, but not all of it. So you choose a percentage that covers nearly all the price movement we see about price either side of the line. But then when we see it price push out of this, this is the unusual time, and that is our trading signal. Now, we talked last week that you can, when markets are trading in these different states, trending up, trending sideways, trending down, there are different ways of looking at it. And there's the trend following way, which we've seen is Richard Dennis saying that when the big trend happens, you want your signal to get you on the right side of that trend. There is a kind of different type of thinking, which is to try and sell new highs and buy lows, the counter trending method when the market is trading sideways. And this is actually one of those examples of a method that tries to do that. So it's designed for when the markets, you've identified the market is trading sideways. And the entry signal is when price crosses into the envelope, and the exit signal is when it breaks out of the envelope. So here's an example of the S&P 500. It's a daily chart. And we put on a percentage filter on here. This is with a 6% filter on a 60-day simple moving average. And we can see the market is trading sideways. Our moving average is fairly flat. And then we've got our envelope either side of that line. So when it breaks into, so here we've seen it's come out and then it's gone into the envelope. That's saying, okay, we're at the extreme end of the range. Now we're going to, so the extreme low end, we're going to buy. And then when it breaks out is when we're going to sell. And then here we give another entry signal. It breaks back into the envelope. And then we sell. We buy back when it breaks out here. Breaks back in. It's another buy signal. It's a bad signal marked on this one in October because it quickly goes back down again. And there's another bad signal in October. But then and if we look at December, the final red arrow is marked at the top of the envelope. That is where the price breaks in is a sell, and then we'd sell it once it breaks into the market. Sorry, the final point there, yeah. So let's try and look at an envelope, applying a percentage filter, an envelope filter to an actual chart. So let's once again go to eToro's platform, and I'm going to look at L'Oreal for this one. Okay, so the way the platform, the charting package here works is with those moving averages that we applied before, they're still showing. So I'm going to remove those moving averages, and I'm going to, rather than look at a daily chart, I'm going to look at a 4-hour chart for this one. And once again, so I'm going to choose an indicator. We've got a list of indicators here, and the one I'm looking for is the one that's called envelopes. So it's instantly added on these blue envelopes above and below with this central line, and it's doing this on default value. So we'll click on the settings button and have a look at what our inputs are. So this is using a 10% filter here, and we can see that with that 10% default filter, it's actually far too wide for what we're looking at. It's over describing. It doesn't match the tendency of where price goes. It's too far. So we can fiddle with this a little bit, maybe 5%. We can still see it's too wide. So if we go 4, once again, it's still too wide. If we put 3 looks good in that. What we're seeing is that it's most of the time price is held within the filter, but occasionally it pokes outside of it. So that if we go to July, we can see this. So it's entering into the filter as our signal to trade. So this will be a sell. And when it breaks out, we buy, and then we buy as an entry signal here in July as it goes back in. That one wouldn't do as well because we'd sell out here, but then we'd buy back in here. And then we would sell to take profit here, buy, sell again to open a position, buy back here, and then buy as it comes back in. So you can see when it's range trading, this is doing a good job of describing the outer edges of the range and giving you trading signals that work. Obviously, the tricky thing is that if this breaks out of the range, then it will inevitably give you, if it breaks out to the upside, it will give you a buy signal and you'll be the wrong side. Sorry, it will give you a sell signal and you'd be caught the wrong side. You'd have counter trended and you'd be facing the wrong side of the trend, doing precisely the opposite of what we want to do when a new trend begins. So risk management, having a stop loss in place to protect you against that would be very, very important. And one of our future presentations will be looking at risk management. We'll talk more about this kind of thing. So then another indicator we want to look at is Bollinger Bands. A Bollinger Bands uses something, rather than just being a set percentage away, it uses something a little bit more sophisticated. So what Bollinger Bands do is uses this statistical measure called a standard deviation, and that takes into account price volatility. So the percentage envelope that we just looked at doesn't look at volatility at all. If price is whipping around a lot, price is just muddling along in a very tight, narrowly close to a central mean, it doesn't do anything, the filter. It will just remain at the percentage you told it, which is that fixed percentage. That's exactly what it does. Bollinger Bands tries to be a bit smarter than that. So it uses standard deviation. Standard deviation is a statistical measure that tells you how dispersed a data set is. If you've got a high standard deviation, then the data points will be far spread apart from each other. And when the standard deviation is low, then prices will be very narrowly scattered around the mean, the arithmetic average. So the indicator plots a simple moving average, and then it puts bands either side of it. There are a number of standard deviations above and below that simple moving average. So you could put it, if you put in that n equals 3, that would be 3 standard deviations away. If n equals 1, then it would be 1 standard deviation away from that that central line, which is the simple moving average. And because it's been calculated as in relation to the standard deviation, when we look at prices, describes volatility. It describes if prices are whipping around a lot, then the standard deviation is going to be larger. If prices have been not whipping around very much, then the standard deviation is going to be low. So our bands are going to expand when volatility is high, and they're going to contract when volatility is low. As it says here, bands widen as volatility increases, bands narrow as volatility decreases. So straight away, our indicator is telling us visually what's going on in terms of volatility. That's pretty useful. And then if price breaks outside these bands, that indicates an extreme price move, which then tells us, hey, maybe something's going on that we want to pay attention to in terms of potentially a change in the trend. So here's an example of Bollinger Bands on a chart. There's a daily chart of oil, and we put on some Bollinger Bands with 2 standard deviations as being the setting for how far away those bands are going to be above and below the SMA. And the SMA we're using here is a 20-day SMA. And those settings, 2 standard deviations away, 20 periods, those are the standard default Bollinger Band settings that are generally used, but you can alter them as you see fit. So a break. So Bollinger Bands, as opposed to we looked at the percentage filter method, we're saying that was actually for a sideways market trying to trade within the range. We're doing something different now. We're actually going back to trying to trade with the trend. So here, a trading signal is a break outside the Bollinger Band. If it breaks above, that's a buying signal. If it breaks below, that's a sell signal. So we can see here with oil, the green arrow on the far left shows where we got a price breaking above the upper Bollinger Band, and that is a buy signal. Price then did trend up in February into March. And then what we get in the middle of March, I've got this red circle marked on the chart. This is where price comes down and crosses the SMA at the middle, and this is the closing signal for this method. And then we can see in May, we got another buy signal, which wouldn't have, would have done all right, actually. So but you buy there, we can see price did continue up, but by the time you got your close signal, which is price crossing the SMA in middle of June, you're probably only taking a tiny bit of profit there. The timing of that hasn't really maximized the price move. And then we get a sell signal in late June. And then we get the closing green circle where it crosses back above SMA. So that'll be a buy indication to close your position. And then this one in August would be a bad signal. It's telling to sell because it's broken below the lower Bollinger Band. And then the closing would be where it crosses over the SMA a few weeks later, and it would actually be at a bit of a loss there. So you can see the methodology there with using the Bollinger Bands. Let's go back to the platform and take a look at adding those to a chart. So I'm going to go and look at oil. So once again, this has just retained a percentage envelope from before. So let's remove that. And I'm going to add some Bollinger Bands. So we'll go to the indicators icon, scroll down to Bollinger Bands. We can see it's here. And if we just check on our settings, the inputs, the default settings, length 20 SMA, this mult is the multiple of standard deviations away, the N, the value. So there's 2 standard deviations above and below. And let's have a look at it on a daily basis rather than on a 4-hour basis. And I just want to look here so this is a few months ago in mid-July. We can see we got this break outside the top Bollinger Band. So this is a buy signal you've got in the middle of July, 13th of July. Buy the market there. A new uptrend does begin. We've got a sell signal when it crosses here. So we would have got out of the position here in mid-August. These probably would be a little false sell signal here in August. And then you'd have another bullish buy signal in early September. And then your close would have been here in early October. And then this would have been a sell signal, which would have resulted in a loss. So you would have been saying, okay, here's a sell signal. Could be a downtrend beginning because we've got this extreme price move below the lower Bollinger Band, but it didn't result. We actually got this big pullback that would have closed you out here, although it does look like perhaps a downward trend is forming there. Now, counter channels is another type. It's similar-ish to Bollinger Bands, but it's calculated in a different way. So in this, the SMA is actually calculated in a slightly different way. It's an SMA of typical price. So the devisor of counter channels came up with this idea, this definition of typical price, which was the close plus the high plus the low divided by 3 to give you this value of typical price. And then you apply the moving average principle to those values. So you, for each period, you would calculate what the typical price was, close plus high plus low divided by 3. And then you take the values of that typical price across multiple periods. Say if it's a 10-period SMA, then you would add up 10 of those values, divide by 10 to give you your one value for that period. And then bands of are plotted above and below that central line are a simple moving average of the daily range. Obviously, daily range is just high minus low, and then that is plotted above and below the middle line. So the original model, when this was originally devised, was to use n equals 10, but it's more usual these days to use n equals 20. And I think this is just kind of good general rule, is just always experiment, see how it looks with different values, use whatever works best for you. Well, I've got an example here of the S&P, the SPDR ETF, and it's a daily chart, and basically it's the same principles would apply as we were to make an apples for apples comparison. Actually, yeah, so this is a chart of countenance being applied to the SPDR, but the actual example I want to look at is oil. So to make an apples and apples comparison with the Bollinger Bands, we want to apply it to the same market with the same kind of settings. So I've applied the 20-day settings to a daily chart of oil here, and we can see that a bullish signal is when it breaks above the upper end of the Keltner channel. And then your closeout signal when it crosses back below the central line again. So it's doing a very similar thing to what we saw with Bollinger Bands. And then finally, of our bands, channels, envelopes section is Donchian channels. It's a simpler method. It's been around for a long, long time. It's been used for decades and decades in the commodities markets. Donchian breakout method is a simple trend following system. In fact, this is one of the methods that Richard Dennis, who we talked about at the beginning of the talk, Donchian breakout was one of the methods that he sort of had, that he used for trading commodities. So all it does is it looks back and compares current price to the highs and lows over a previous number of periods. So all of these methods are effectively kind of price look backs. We look at current price, we compare to what price has been doing, and we work out whether it's looking extreme or whether it's looking normal. So a typical usage of Donchian channels is to use a 20-day high and a 20-day low. And you just compare where price is compared to that. The price is between the 20-day high and 20-day low. You don't do anything. But if price breaks up, so if the current price goes higher than the highest high of the previous 20 days, then that's a buy signal. If it goes lower than the lowest price, if it goes lower than the lowest price we've seen in the previous 20 days, that's a sell signal. So once again, this is a chart showing Donchian channels applied to a daily oil chart. So I'm trying to keep these the same. We had oil for counters and here's oil for donkeying channels. And it does a really good job of describing where price goes. So we can see that price doesn't break out of this very often at all. Very occasionally, price will peep its head outside. So we can see in early 2022, we got this break above the high, the previous high, and that gives us a buy signal, and it does presage the new trend. And your sell signal with this would be, there are no hard and fast rules for these, so you could use whatever you feel most appropriate. One possible one would be crossing through the central line, or you could have it if it crosses below the so you need an opposing signal. So if it crosses below the 20-day low, then that would be your sell signal to close if you have a long position. So general kind of usage of bands and channels. So we've already sort of looked at some of those things. Price breaks the edge of the band. It may be indicating to you that this is a signal of a new trend forming. A typical pattern that you tend to see with the indicators that measure volatility is that band tightens as market volatility ebbs. And as volatility returns, usually you get sharper price moves, the bands widen, but usually that's where you get your breakout occurring. So what tends to, all things being equal, sort of a very, a general observation is that in sideways markets, you tend to see volatility getting very narrow. It goes out of the market. When vol picks back up, you'll sometimes get a breakout. Vol will increase, and so your volatility channel will widen. And this kind of behavior is what makes volatility channels like Bollinger Bands and Keltner channels not very useful for trading sideways markets, is that those bands are going to get really, really narrow. And the sort of difference, even if you do get trading signals there, they're not going to be giving you much chance for sort of getting profit or getting them in good time to actually profit from the price movements. Another decision you have to make is to decide whether you use end of day or intraday values to define a break. We talked about that before, whether you might want to just to be more sure of it, you might want to wait for the actual close to define the break and not use an intraday value, but it's up to you. And we said there's multiple ways you could decide what the closing is, but you can use that moving average in the middle as a trailing stop level. So if it comes when we get a breakout above or below your band, you can use that moving average maybe as a stop. So if it crosses or touches that moving average in the middle, that would be your closing price. As always, look for confirmation of the trends. We mentioned that confirmation was an element of Dow theory last week. We're going to be spending the whole of next week's presentation looking at confirmation. So we'll be talking a lot more about methods we can use to confirm that what we're seeing is something we can have more confidence in. So now I want to spend some time talking about retracements. Not particularly complicated retracements, they're just something that we see, so it's worth talking about. So remember what we talked about last week. We said when we talked about some of the principles of Dow theory. Dow theory said there's a primary trend, and then there's this secondary trend, which is a counter trend. So modern technical analysis calls this a retracement. So it's a correction to the principal trend. It's like a mini trend with an overall within an overall larger trend. You often see this after a breakout. We've been very interested in price breakouts. What often happens is the price break, for example, we looked at last week at the market being in a sideways range, and then if it breaks out of the range, it can sometimes be a new trend. But what often happens is once it goes up, there will inevitably at some point a bit where, just because of the nature of the way price moves, we say it oscillates in waves, there'll be a bit where it pulls back, and that is sort of your retracement. And the beginning of a retracement is always resistance, as in the larger uptrend. So if the market's broken up and we're looking at the formation of a new big uptrend, then your retracement, your secondary trend, is counter to that. And the beginning of it, where it turns away, will be your resistance point. If the market's in a big downtrend and the market bounces back up, then your secondary trend is that bounce. And the beginning of that, where it bounces, that's a support level. That's just almost a truism. It has to be like that. So we can apply trend analysis to a trend, to a retracement itself, as if it's a smaller trend. So let's actually look at a chart and try and talk, because it's probably a bit easier if we actually look at an actual chart to try and explain what we're talking about, rather than me describing it with my hands in the air. So let's go to, I'm going to get rid of my band there, and let's have a look at the S&P 500. So this is the S&P 500, this is a daily chart. So let's just look at what it's actually been doing this year. So we can see, I'm going to grab a trend line. We can see that here we've got a sort of previous uptrend. I'll put on a very rough trend line. But then, I mean, it's not particularly good. Let's make it a bit more like this, and I'm going to extend it a little bit. So we can see how that previous uptrend trend line joins these previous levels of support. But in August, price broke below that trend line, which would be an indication to us, okay, maybe something's happening with this trend, maybe it's coming to an end. We could also apply some moving averages to maybe clue us in as to what's going on. But we can, this is with the power of hindsight, we can see that the price has generally moved lower afterwards. Let's not use this, that's not good. And this isn't a proper trend line, I'm just giving you the direction with this line. Now, at the time it broke below our previous trend line, our uptrend, as I said, we might be thinking, okay, something's happened. We wouldn't know for sure that this is, it might just be easing off, decelerating. It might be moving into a sideways trend. We have to wait and see to confirm what's happening. But what we've actually seen is a breakout resulting in a new trend. Now, the initial break eventually runs out of steam a bit, and then we get our retracement. So So I've marked on there where that retracement is. And we can see that the beginning of the retracement is a support level. Now, it's possible that when this breakdown occurred, that you just jumped on it. You saw, oh, this is a breakdown. But there's every chance, as I said before, that it might not have been apparent to you what's going on. And therefore, what the retracement offers is a potential jumping on point And you can say that's also true of a second retracement point, because we can also say this here is another retracement, and that once again is another jumping on point once we've seen, because at that point we'll have seen that there is we have more information about what's actually going on with price, more indications that a downtrend is beginning. Now, the end of a retracement can show us support or resistance for the main trend. So it's telling us some information because of what we said before, where those retracements occur, tell us about support and resistance levels. And the size of a retracement can also inform us about the main trend. So how big or small that retracement is might clue you in as to what's going on with this sort of strength behind the trend. And as I said when we looked at that chart, it can provide an opportunity to join the main trend. It's a jumping on point. So if you've got a very strong trend, then you tend to get smaller retracements. So 33% of it retracing the price back from peak to trough suggests a strong trend. Retracements can also be a warning. So if you get an extremely big retracement, then that, especially if it follows after a smaller retracement, that might be an indication that the trend is sort of under threat or running out of oomph. So this final point, 50% retracement after a prior 33%. So 33% might indicate, wow, this is a really strong trend, but then it retraces more the next time. At the very least, it's showing you that possibly the trend is decelerating. So here's just a simple example of the S&P in a big downtrend. The principal trend marks on with this big green arrow, and then some big retracement points, which could be potential selling opportunities. And then this point is about waiting for a post waiting for a post breakout retracement. Some traders choose to wait for price to retrace before joining a trend. So we looked on that example of the S&P, whereas you might not be able to get on the end of the breakout immediately. In fact, you might prefer to wait to see that where it's exhausted itself, comes back temporarily, the trend has exhausted itself, it bounces back, and then that could be an opportunity to join the bigger trend. So you wait for the initial push to exhaust itself, and then you'd have set in your head a certain set percentage retracement that you're looking for. It does run the risk, though, that the price doesn't retrace, and then you just actually miss out on getting on the end of the trend on the end of the trend at all. So one thing other traders sometimes do is maybe they have in their head an overall size that they want to be trading. So in the example we looked at, we go back to the chart of S&P. So it's breaking downwards. You might, on your initial, whatever initial trading signal you might have got here, you might do half there and then save half for the retracement, and then you'll give you the full position. And then even if you miss out, maybe that next you don't get a very good retracement, and instead it just breaks sharply down, at least you've got something on initially. And then this final question, this final point here is how much of a retracement might we expect? So as we've sort of mentioned there, 33%, 50%, 66%, we might do those things. This sort of brings us on to the idea of Fibonacci, which is an attempt to sort of give us some actual levels. Now, in reality, there's no strong evidence to suggest retracements stick to precise percentages, but some analysts do sort of adhere to this idea that there's a hypothesis where there is a tendency to retrace to certain levels. And this brings us into the Fibonacci sequence, which is a well-known hypothesis. So the Fibonacci sequence is this special sequence of numbers and relates to the golden ratio. So a number in the sequence is the sum of the two prior numbers. So 1, 2, 3, 5, 8, 13, 21, 34. So 1 and 2 is 3, 3 and 2 is 5, 5 and 3 is 8, so that, and so on. And then if you divide one number by the next, it tends to give you the same ratio. So for example, 34 divided by the next number in the sequence, 55, gives you this ratio 61.8%, 0.6180. And if you divide by 2 to the right, so 21 divided by 55, for example, it gives you this ratio of 38.2, 0.382. The further on you go in this sequence, the more accurate that percentage becomes. And there are all sorts of weird things that happen with the Fibonacci sequence. For example, if you add 1 to the 0.618, you get 1.618. But if you divide 1 by 0.618, you also get 1.618. And there's all sorts of these weird relations that go on with the Fibonacci sequence. And the idea is that you apply these ratios from peak to trough of price movement to then attempt to identify potential future support and resistance levels. 50% is not a Fibonacci ratio. It's not anything to do with the sequence, but for some reason, the indicator always includes it. So let's look at using, actually the next slide. So here we've got an example of the S&P with a Fibonacci tool applied to it. And what it's using is taking the peak at the top of the downtrend down to the first trough after it of this kind of wave-like oscillation of price. And then from that, it applies all these Fibonacci percentages. And we can see how the support and resistance, or the resistance of this next wave, tends to tie in with the 61.8, roughly speaking. And extrapolated forwards, we can see that some of the negative levels also seem to broadly give us some resistance and support levels. Let's actually go back to the eToro platform and apply this anew to something else. So I'm going to go to going to have a look at the Dow Jones. Dow Jones 30, there it was. So this is a daily chart of the Dow Jones. And our Fibonacci is over on, should be able to find it. Right, so here's Fibonacci retracement here. So let's take the top here and go down to this bottom, or this first trough here, and then extend it forwards. Well, and if we zoom in a bit, we can see that, first of all, that old 50% line tends to actually do a pretty good job of picking this first resistance point that we saw here after the retracement. And actually, if we extend, and then if we then apply it again to this next trough here, we can see that the 0.38% is done a pretty good job also of tallying up with the resistance we saw here in the middle of October. And then if we apply it again to this new bottom down here, I'm going to apply it to the actual bottom of the candle, sorry, the body of the candle rather than the extreme. we can see that this would then give us a prediction where we might, so we, extrapolating it forwards, that 0.382 would suggest that there might be some future resistance around the 33,650 level. And maybe we could also keep an eye out for that 50% level up at 34,040, roughly. So that's just an idea of how you can, or just to show you how the Fibonacci retracement indicator can be applied. So, to summarize, basic overarching principle is still the same. We want to attempt to stay with a trend. This was like our really core principle idea that we had from last time. We want the trend is our friend. Moving averages can help identify the trend by smoothing out the data, stopping us focusing on short-term fluctuations to try and see beyond that to get insights about longer price trends. Dual moving averages, we can use two, a long one, a short one, maybe a long one with a medium one. They can give you crossovers that are signals of a possible breakout, but we always run this risk that breakouts may be false, so we look to confirm with other information. As I said earlier, next week is all about confirmation, so I hope you join us back again next week to talk more about that. And we can use bands, envelopes, and channels as an attempt to weed out false signals, so they only give us a signal when we've seen a very unusual price move. Another sort of an idea from last week with Dow theory, no methods are foolproof. There is no method that's just going to work always. So we have to be careful. We have to be practice what we're doing and find methods that we are confident will work for us. Okay, so if you'd like to put your questions in the Q&A, I'll try and answer them. Right, so I've had a few questions straight off the bat for links to the modules. So I'm just going to put that in the chat now. Right, so I've just put a load of links in the chat, so hopefully you should be able to see those. Someone asked, with a 20-day simple moving average, are the points plotted at the close of day? Does the point plotted at day 21 consist of the average of close from days 16 to 21, or the average of close from day 15 to day 20? So in an SMA, it should use the end of the period. So there probably are more complicated methods where you can specify in your inputs what you want to use. So you could probably tell it to not use the close, but the default is always going to be the close. So if we were using a 20-day simple moving average, the default would be using the actual close of day price. And it's a lagging indicator. So I mean, a good way to look at this is if we go back to, I mean, different charting packages may work in different ways. So you have to try and use your own. It's always a good idea to actually have a look and see if you can work out what it is doing. So let's put in Vodafone. And so this is daily chart of Vodafone. I'm going to add on a moving average. I'm just going to put on a 10-day moving average onto this one. it doesn't really matter. So that's saying a 9-day. Ideally, I'd like that to be away from that. As here, we can see it goes into the middle of our candle. So, I mean, it would be, it's difficult for me to say exactly what this one is doing, but I would assume for this day, it is incorporating the current, it only uses it for the current day once it's got the data for that period. So it shouldn't plot it. It won't have the current day's close until the end of the trading day, and then that would appear. The line would be plotted for that one. So for the next day, when it opens, you shouldn't really get an SMA until the data comes in. But it's always the current period. So this is a 9-day SMA. It's got the current close of days, then the preceding 8 days divided through by 9. Let's just have a look more at the Q&A. It's a question, right? Is there a distinction on what bands work better for different assets, i.e. stocks, commodities, indices? It's a difficult question. It's a good question. What I would say, and it's worth pointing out, and this sort of reminds me to say this, it's a bit of a truism, but a lot of these things were invented for commodities originally. And the general rule is trend following methods should be applied to markets that show a tendency to trend. As I say, that's a bit of a truism because it's pretty obvious. There are some lines of thinking that say commodities are excellent markets for trending, and you can sort of understand the reasons for that because they're so driven by supply and demand that once something starts happening in those areas, if supply starts getting constrained or there's fears over supply, that can start causing an uptrend and that can persist for quite a while. So certainly commodities have a reputation as being good trending markets historically. I think a general rule of thumb is that a sound technical method should work across a cross section of asset classes. Always just common sense is it makes sense to look yourself, apply the tool to past data, see what happens, try and paper trade what would have happened if I'd applied it to these. Do I think this is a good market for it or not? Someone's saying, can you do the Fibonacci retracement on another company, please? I can do that. Let's do Barclays Bank. So here we have Barclays. I'm just going to get rid of my moving average and I'm going to zoom out because so I'll stick with the daily chart. So we can see this one's quite an interesting one, and that this actually does appear to be a bit of a downwards break. It's quite a lot of sideways movement to it there. And if we put on Fibonacci retracement of this, well, what's difficult about this is that we haven't yet seen the bounce. So it would be difficult to apply it to that. So I'm actually the idea would be that we'd need to see from peak to trough. And this shows you a sort of fundamental limitation in that we haven't yet seen for sure where that trough is. If we were to take a guess that we've seen it already, but that would be a big assumption. We would go from peak to trough here. and we would see some other levels. If it's not a particularly good one, that just because we haven't yet seen the price movement happening. I mean, let's try. Maybe if we go to a different, let's go to 4 hour. Maybe we'll see something slightly different. It's a difficult one because it appears to be in the middle of forming something and we can't yet see. So I mean, maybe here we could say that this is our first. So if we apply the retracement from this peak down to where's this coming? Problem I'm having is I'm still identifying what the actual price movement is, so that rather than just trying to apply it blindly, I fear it wouldn't yield anything very useful. Certainly in the daily, we're seeing sideways movement there, and then a break to the downside. Still seeing that sideways movement here, and then a downwards break. So let's try and, just as an example, to apply it from here as if this is the start of our breakout. And that we're saying this is the first bounce. And we can see where the retracement levels are saying we should look out for. And this would be in a very kind of predictive way, because we're not yet seeing anything yet to confirm it with. But it would be saying that 0.38% is here, 0.5% is up at 140, the 62% is 144. Someone else was asking, where does the 78% and the the 0.23% come from? They will be derived from the Fibonacci sequence with taking ratios of numbers in the sequence another step along. So it's probably, we said, divide 1 by the one next to it to get 0.618. We divide 2 along to get 0.38. If you divide 3 along, then you're probably going to start yielding some of these other values. And then we go back to my questions, and then I'm just going to look at one last question because we've really overrun in time. Okay, someone asked, can I try Fibonacci on gold? Okay, let's do that. And someone else asked, how do you choose the trough of Fibonacci chart? So we can do 2 in 1. Let's try and do that. So let's go to gold. Ideally, we want to find a market that's actually showing us the correct conditions. In other words, we want to see it having broken out and given us a first retracement in order for us to work out what we're doing from that. So let's go to daily gold. I am going to put a moving average on just to try and help me see what's going on a bit better. There's two, right? So there's the first question is, where do we get at? How do you choose the trough? It's a good question, but it basically comes down to where we've seen the breakout and then we see a first retracement. We would use a peak to trough of that. This is not a particularly great example of it, but let's say that we could say that this, we've decided, we've seen previously, I mean, this is a 60-day moving average. The 60-day moving average has been moving down, and now it's turned up and price has crossed above it. So one way of interpreting that is saying that we've had this little mini downtrend here for the last few months, and then we've got signs of a reversal, and it's now heading up again. Now let's say that we're treating this as if it is a break to the upside. It's not really great. I mean, ideally, what we'd really want to find a market that's been in a rectangular pattern, i.e. moving sideways and then broken out. That's the one we'd ideally like to look at. And then we would go from the breakout level to the first retracement. So straight off the bat, we've got a few arguable bits of what we're defining as where are we defining the breakout happened. So I would say gold is not a particularly good one for this right at the moment, because it's actually in a way looking reasonably sideways. Although we could say, I'm going to add on another moving average just to I mean, gold here currently is giving me an indication of an upwards break, so it's not particularly, I guess we could say, let's say that we for the purposes of the example, that we've decided this is the beginning of a reversal, and then we're saying this point here, and it's not a very good, this is not perfect because it's not clear at all this is what's happening. But let's say that this is our first retracement. Then applying the Fibonacci to this, what we'd be seeing is that we get these predictions of where we might find support at these various levels, and where we might expect it to retrace down to here. At the same time, I wouldn't have much confidence in this because I've spent literally 2 seconds looking, 2 minutes looking at it, and it's not really meeting the conditions that I would normally like to apply it to, which would be a breakout from a kind of sideways position, and really want to see a bit more of clear evidence of this being a proper retracement. That said, if we were interpreting this as being an upwards break, when we've got an indication of an upwards break from this shorter moving average breaking up above the longer moving average, and we are seeing something of a retracement there, if we were going on the back of that, then we might say, okay, I'm going to keep my eyes peeled. Really, at this 0.38 would be like a level where you think, okay, maybe there's going to be some support level there, maybe 50%. You keep an eye out and see what the market behaves, because support and resistance can reinforce itself. So that going forward, if you do see that happen, you might have some confidence that those are support levels that might hold going forwards. Okay, so we've really overrun in time, and that's all we have time for. Thanks so much for all the questions you put through, because they're good questions, and I enjoyed trying to answer those as well as I could. Thank you very much for your time and for taking the trouble to log in. Please come back next week and join us again when we're going to be spending an hour looking at confirmation methods. One of those is the RSI. If you want to learn how to use the RSI indicator, please come back again next week. Anyway, thank you very much. I'll see you next time. Goodbye. The bad part is silly. Where it's like, hey, my first time.